Good day everyone, it's me LEMENIO, and for today's video we'll be discussing about strategic control system and identifying control problems. So stay tuned and let's get started. Strategic control systems. To be able to assure the accomplishment of the strategic objectives of the company, strategic control systems become necessary. Before we proceed on these systems, we need to define first the strategic control. It is the process used by the organizations to control the formation and execution of strategic plans. It is a specialized form of management control and differs from other forms of management control in respect of its need to handle uncertainty and ambiguity at various points in the control process. The strategic control systems consist of the following: financial analysis and financial ratio analysis. First is the financial analysis. It refers to an assessment of variability, stability, and profitability of a business, sub-business, or project. It is performed by professionals who prepare reports using ratios and other techniques that make use of information taken from financial statements and other reports. Next is the financial ratio analysis. Financial ratio analysis is a more elaborate approach using in control activities. Under this method, one account appearing in the financial statement is paired with another to constitute a ratio. Financial ratios may be categorized into the following types, and these are liquidity ratios, efficiency ratios, financial leverage ratios, and profitability ratios. So, liquidity ratios. These ratios assess the ability of a company to meet its current obligations. And these are the important indicators of liquidity. First is current ratio. This shows the extent to which current assets of the company can cover its current liabilities. The formula for this is current ratio equals to the current assets over current liabilities. Second is the acid test ratio. This is a measure of the firm's ability to pay off term obligations with the use of current assets and without relying on the sale of inventories. The formula of this is acid test ratio equals to current assets minus inventories over current liabilities. The next type of financial ratios is the efficiency ratios. These ratios show how effectively certain assets or liabilities are being used in the production of goods and services. The common efficiency ratios are the following. First is the inventory turnover ratio. This ratio measures the number of times an inventory is turned over each year. The formula for this is inventory turnover ratio equals the cost of goods sold over inventory. Second is the fixed asset turnover. This ratio is used to measure utilization of the company's investment in its fixed assets, such as its plant and equipment. The formula for this is fixed asset turnover equals net sales over net fixed assets. For the third type of financial ratio is the financial leverage ratios. This is a group of ratio designed to assess the balance of financing obtained through debt and equity sources. Some of the more important leverage ratios are as follows. First is the debt to total assets ratio. This ratio shows how much of the firm's assets are financed by debt. The formula for this is debt to total assets ratio equals the total debt over the total assets. Second is times interest earned ratio. This ratio measures the number of times that earnings before interest and taxes cover or exceed the company's interest expense. The formula for this is time interest earned ratio equals profit before tax plus interest expense over interest expense. The last type of financial ratio is the profitability ratios. These ratios measure how much operating income or net income a company is able to generate in relation to its assets owner's equity, and sales. Among the more notable profitability ratios are as follows. First is the profit margin ratio. This ratio compares the net profit to the level of sales. The formula used for this is profit margin ratio equals net profit over net sales. Second is the return on assets ratio. This ratio shows how much income the company produces for every peso invested in assets. The formula used for this is return on assets ratio equals the net income over the assets. And the last is return on equity ratio. This ratio measures the returns of the owner's investment. The formula for this is return on equity ratio equals net income over equity. So let's proceed to identifying control problems. Recognizing the need for controlling is one thing. Implementing it is another. When operations become complex, the engineer manager must consider useful steps in controlling. Krutner mentions 3 approaches. First is the executive reality check. Second is the comprehensive internal audit. And third is the general checklist of symptoms of inadequate control. Executive reality check. Employees at the front line often complain that management imposes certain requirements that are not realistic. Comprehensive internal audit. An internal audit is one undertaken to determine the efficiency and effectivity of the activities of the organization. Among the many aspects of operations within the organization, a small activity that is not done right may continue to be unnoticed until snowballs into a full-blown problem. If a comprehensive internal audit cannot be availed of for some reason, the use of a checklist for symptoms of inadequate control may be used. Krittner has listed some of the common symptoms as follows. An unexplained decline in revenues and profits. A degradation of services, customer complaints. Employee dissatisfaction or complaints, grievances, or turnover. Cash shortages caused by bloated inventories or delinquent account receivable. Idle facilities or personnel. Disorganized operations or workflow bottlenecks, excessive paperwork. And lastly is the excessive cost.